Welcome to RodneyABrooks.com. Today we're talking with Mitch Katz, partner with Capital Associates based in Bethesda. It doesn't matter who's in office, but still there generally is some volatility leading up to the election.
Oh, absolutely.
So how do you hold your client's hands?
Yeah, just sort of like with what I just said.
Right.
I said, pay no attention to it. Go back to doing whatever it is that you enjoy doing with your time. This is just information entertainment, and pay no attention to it. And we do that by actually supporting it with the charts and graphs and the numbers and stories and giving examples of, in 2016, they had an election between Donald Trump and Hillary Clinton, and the pundits said Donald Trump was going to wreck the stock market and Hillary Clinton was going to win in a landslide. And on election night, the futures reflected that. The gold prices spiked because people were scared, and the futures went down. What happened? Well, over the next couple of years, the stock market roared, and here we are. And they also said the same thing about Joe Biden. He was going to wreck the stock market. Yesterday we hit all-time highs. Here we are. So we pay no attention to what the predictions say because they're always wrong. And bottom line is that's how we talk to our clients. The same exact way I'm saying is here is giving examples, giving them the stories, giving them the data, and telling them to go back to what's important to them because this is not important.
Okay. So to sort of wrap this part up, there are people, and I've known them during my career, who get out of the market during when it gets crazy.
Yeah.
And so I mean, how much do you have clients who actually said, I want out because
Absolutely.
of volatility, and
Yeah.
you say, don't do it because
Yeah, so that's called market timing.
Yes.
Market timing. And Vanguard's the largest do-it-yourself money manager on the planet by far. And they actually had a huge study on this. And they actually were able to quantify market timing and the value of a financial advisor. And so going back to these numbers, in a round number, your average rate of return on a S&P 500 fund, ETF, however you want to describe it, over time is about 10%, 9%. And the average investor, for a lot of different factors, is about 5%. So there's a 4% gap. 2.5%, 3% of that is attributed to market timing, getting in and out at the right time. You might get it right on the way in, but you won't get it right on the way out, or vice versa. It's almost impossible to get it right on both times. So they actually have huge studies on this, and it's next to impossible to predict when to get in, when to get out. Again, we share these stories, we share this data with our clients, and all of this goes back to the financial planning process. You get anxious about your money when you don't actually have a plan. I should have said with the financial plan, when you get on an airplane, the pilot comes on and they say, the flight's 2.5 hours, the tower has cleared us, there's gas, they're just cleaning the restrooms, we're just waiting to take off, and runway's clear. And, we have a flight pattern, there's some weather, we're going to go around it, and that's the announcement. If they came on and they said, we're not cleared, no idea if they put gas in this thing, bathrooms definitely aren't clean, you may or may not get drink service, you're not staying on that flight. So people run their financial lives without that flight plan in their own personal financial lives. You have to do that. You would never build a house without a blueprint. So at the end of the day, once you have that financial plan blueprint and you know those numbers, it takes a lot of that anxiety away from the gyrations and the volatility of what's happening in the market, and it makes it a lot easier to stay the course because you know where you're going. We also implement other sort of strategies to counteract that. So for instance, as people are getting ready to retire, we know that there's going to be volatility in the market. When? No idea. None of us do. My guess is we've seen two major events in the last number of years. So you had 2008 and we had coronavirus. So are we going to see more of that or less moving forward with globalization? My guess is we're going to see a little bit more. So we know it's coming. So you want to take 3 years worth of your living expenses. And again, let's just go back to that $10,000 a month number. That's $120,000 a year, inflation adjusted, of course, but we want to take 3 years of that and a round number, $300,000. We don't want that in the market. We want that invested into, short-term bonds, cash, stuff like that. That way, when your portfolio goes like this, we turn off the distribution out of the big portfolio, out of the principal portfolio, and we turn it on the smaller one that's going to ride out the storm. Average length of time in a recession or a down market, short one's 18 months, long one is 36. These are averages, but again, about 3 years worth of cash flow there. We burn that down, that crisis ends for the time, and then we let the market return, and then we refill the portfolio. So that way we have multiple strategies in place in order to combat the angst of, oh my gosh, my money is gone down. So that way we know, hey, we have a plan, we're executing on the plan, we've seen this before, we have some stopgaps in place, and off we go.
So that's basically, so you're setting this money aside that you're going to be drawing distributions from, which means you don't have to draw distributions from a portfolio that may be down.
That's correct.
And it has an impact for years to come.
Exactly. So we're never creating that loss. We're right away, day one you retire, and really a year before, right? We can't do it on the day you retire if the day you retire is 2008 or coronavirus. So we do it a little bit before. We have that money set aside. We had clients that literally retired in the middle of the '08 crash and the coronavirus. And, so long story short, but we had already had that money set aside, and we withdrew the money from the accounts that don't create that loss for us. So it doesn't reverberate throughout your next 20, 30, 40 years of retirement.
Okay, so my last question actually is related to basically your commitment to financial literacy. Okay, you've taught basically financial literacy in urban high schools for years.
Yes.
Where did that come from? Where did that commitment, why do you do that?
Yeah, I sort of fell into it. I was I was involved with a charity that asked me to speak to high school kids, and I didn't really know what I was getting into. I didn't know what I was stepping into, but when I stepped into it, I was shocked, beyond shocked at the lack of all of it. I mean, I know very wealthy people that don't know these things, but I didn't realize how bad it was across the board. And so, they needed help, and I felt like I was the right person to be there and help, and it's been super rewarding for them, and I know it's been super rewarding for me too, and I absolutely love it, and made a lot of friends out of it, a lot of great relationships, and continues to expand and get bigger and bigger. So it's been great.
So do you have former students who come to you and say, God, thank you, this is where I am now, this is...
Yeah, I do run into that, which is really rewarding. We had one student, and I think I told Rodney the story. I said, what do you want to do? And he said, I want to clean houses. Okay, great. Why? That's what my mom does. Okay, come to my office, sit and watch what we do here, and let's see if we let's just learn about it. And by the end of the first day, he said, Mitch, I don't think I want to clean houses anymore, which is nothing wrong with cleaning houses, but and he that changed his direction, and he learned so much about his own money. And it goes back to teach a man to give a fish or teach a man to fish, right? And it goes back to the village. So that was pretty rewarding, and lots of stories like that, but that's one that comes to mind.
Okay, and so I said that was the last question, but this one is, so where do you think the Washington Wizards are going to end up this year?
This year? Well, after the number 2 pick went 0 for
15.
0 for 15, I don't have high hopes. But there's a number 1 pick there, so I hope that they end up with the number 1 pick. So I actually hope they lose as many games as they need to get into that slot. That's my answer.
Okay, so thank you, Mitch, for giving me a talk to Mitch Katz, who's a partner in Capital Associates based in Bethesda, Maryland. Thank you so much.
Thank you, Rodney.
Okay, for coming.
Appreciate it. Thank you.